2023 credit card debt. All right, so we've got let's see here, a few statistics that I looked up. And so I always enjoy those videos, so I decided to put one out myself, maybe try to hopefully have a little bit different. But when I came across some statistics, I was like, what is that? There were two very different statistics regarding the average credit card debt, and the report on the website was literally, I wrote down, it's 2 days separately. And so it's about $2,800 difference, and one higher than the other. So the first report, because today's April 23rd, on April 18th, Credit.com came out with a report that said the average credit card debt was $9,260. And on April 20th, 2 days later, Credit Karma has a notation that the average credit card debt in the U.S. was $6,469. So supposedly, Americans possibly paid off $2,800 in 2 days on average. But that was something that was pretty alarming. And the day before the Credit.com report, the average interest rate in the U.S. is over 20%. Now, I started thinking about that because I have really good credit. I don't always get the lowest rate offered, but I do pay it in full. So it was just like over 20%. And I was like, that seems low compared to some of my rates. And it is higher than some of my rates. My regular APR. So I think that could be including, because someone did mention this in a podcast or a YouTube video I was listening to, that includes when you hear that average rate is 18% or average rate is 20%, that is including the introductory offers of 0% and stuff like that. So, okay. Oh, there it is. Okay. And I'm looking at myself on my phone. And so when I look over here and I see myself, my eyes go over there and it doesn't look like I'm looking at you. So, what else? There was the CFPB, Consumer Financial Protection Bureau. So there's Consumer Protection Bureau. If there's any bank, insurance, credit card, something that comes up, you're not getting reimbursed, you can in turn report them and basically say, hey, I was supposed to get this offer. And if you didn't get the offer, I've thought about reporting one of my credit card companies. I have to try to call them first and see about getting the $5 rebate. I was supposed to spend $50, get $5. I have the email still, but luckily I still have the email. I don't want to have to track that email down, save a PDF file of it, and then do all this stuff to get, $5. By the time that, I put all the effort and time into it, it ends up being you earn 50 cents. I don't say 50 cents an hour, but, 50 cents to $2 an hour if it took you, 2.5 hours to do it, to get the $5. But it was with it, it's 10% cash back on top of the regular 2% I received. Without it, it's I could have earned 5% cash back because I chose to use that card. So it's really I don't want to say losing money, but it is. And so what else? Oh, there was another website. So there were two websites. There was a statistics website, and so the CFPB, the CFPB is the one that put the proposal and for the law to be changed on the late fees. If you've ever paid your credit card bill late, there is this huge $35 fee. It used to be $35, but when I looked it up, it was could be rate as high as $41 for a late fee. And who was the smartest guy in the room back in 2008? Someone had mentioned a strategy to get the right approvals, a formula, and you could knock almost 90% of those approvals down to zero. I was watching a documentary on this. You could get those late fees wiped out. They wouldn't exist. And supposedly the smartest guy in the room, whoever it was at the time, said, maybe they wasn't Jamie Dimon, but someone else. And everyone knew that he was the guy to look at, was the quote, and listen to. And he raised his hand and said, but that's where 90% of our profit comes from, these late payments. They get a lot of, lucrative payments from those late fees. And not just that, like they're getting the interest from those borrowers. So if they're not approving those borrowers, but also I do think that if those borrowers did not get approved to begin with, then a lot more people would have to do a lot more financial planning because they would not have credit cards as an option, and that could do something for the pocketbooks eventually over time to save and invest. It could demand higher wages. It could do all these things. There's a controversial website, I guess. It's called blackenterprise.com. And so I have it bookmarked on my other phone. Not bookmarked, I have it in my history. And there was debt.com. And so blackenterprise.com said in 2021, so this is like 2 years ago, September 2021, 1 in 5 people have over 20K in credit card debt. And that was like, okay, so, every 5 people you see, I'm a cashier, so I see a bunch of customers, 100 customers, 20 of them have over 20K in debt. Granted, that could be, their debt to income ratio could be different if they're making 120K, if they're making 500K, or are they making 35K. So, that was something to put in consideration in conjunction with there's debt.org. Okay, so debt.org on April 3rd this month had some alarming statistics, and you can go there. And from the lowest net worth, a family net worth, so I guess that means husband and wife. It didn't say household, it says family, so maybe children as well. But I'll start from the bottom. Black or African American is 24K, and Hispanic or Latino is 36K. Other mixed races are 74.5K, and the white non-Hispanic is 188K. And so I was like, at first I thought it was 118 when I first went on the website. So I'm sitting there and I came across this statistic, and I have this video out, or it's a podcast, where I specifically remember, that's why I thought it was 118K. The report had said that blacks whites have 5 times the net worth of blacks, but that's coming up on 6, 7, maybe, it's coming up on almost 8 times the net worth, because I'm not doing that math in my head. Okay, 7.8 times the net worth. So it's coming up 8 times the net worth, less than 2/10 away from being, 8 times the net worth. And then the mixed races, a lot of people with the Asian background, they do tend to earn more whenever I see those statistics. But there's also, when the mixed races, you have a black and white household necessarily. So you have a high net worth background mixed with a low income background. So that could be it. I want to say that could be potentially drawing it down. And to say, like, people do say this thing, they say it is your choice to have a high net worth or a low net worth. But that's inherently saying, like, a whole race of people intentionally is choosing not to have a higher net worth. And it sounds really racist because you don't say that, but you're saying that. And it's really bad, just from my opinion. And I didn't want to state my opinion because I can piss a lot of people off, but if you disagree, put it in the comments. So we got the silent generation. Baby boomers, Gen X, millennials, Gen Z. That's total debt. So Gen X has the most debt with 135K. I guess that includes everything. And Gen Z has the lowest at 95, 93. So either it was Credit.com or Credit Karma that had mentioned that Gen Z was actually also increasing their debt the fastest, their credit card debt the fastest. But at this point, they don't have necessarily all these different things, unless it's like student loans or getting a house. So maybe not getting a house, maybe a student loan. That 9,593 could be a car because they have maybe higher disposable income if they're living at home. Income by education level. No high school is $30,784 all the way up to a doctorate degree of $97,916. I think that's really low, even for a doctorate degree. I have my master's degree myself, and that's $77,844. And so, is this starting? It wouldn't be starting for no high school. And it goes through high school, some college. That's income, education level. This is on, you can find this on debt.org. But, that was some things. The CFPB aims to slash the late fee by $8, but I think that was about it. I only spent like 30 minutes, researching what some of the sites were saying about different credit card debt and different stuff that was going on. And so, CFPB, I wanted to mention that. So the Credit Financial Protection Bureau, there's the FTC, there is the Better Business Bureau, and there is the Consumer Protection Bureau, right? And so one time I remember I was like, I'm going to report this company to all of them. And it was over it wasn't over $5. That instance was $5, but it had happened several times. And it was an investment firm. So, I don't think it's fixed. I still don't think their system's fixed. But I just don't make the transfer outside of trading hours. That's the only time it's accurate. And that shouldn't happen. I shouldn't have to remember that. I don't know how much stress that is on me. And I don't know how long, you want to keep a brokerage firm necessarily if they're have unnecessary stresses that you don't need. I particularly like that this one offers partial shares, and that is something to weigh in on. I can get 20 to 100. I think I have 300 partial shares at least. But you go to another brokerage firm and you can't do that. And then because they were as well as they were charging for years. And, a lot of people, they don't know what a life was like before trading, when you had to trade. If you traded in a huge sum, it wouldn't necessarily be worth it. I traded in lower sums, so it wouldn't really necessarily be worth it to trade below $500. And if I was trading below $500, say I was going to get one share, why would I get one share for $100 and something? That didn't make any sense. And you would have to pay $7 to $14, whichever brokerage firm you were at, and $7 on the front end, $7 on the back end. So the stock, if you had one share, would have to go up $14 to break even. And that was a life that was just it wasn't fun. So I eventually learned my lesson towards the end when the trading fees were not there. They were you can trade certain ETFs for free. Each brokerage firm was you could trade certain ETFs for free, and no load, no transaction fee, mutual funds were free. So I was only trading those for the last year and a half. So at this point, I'm in my late 30s. I started trading when I was maybe 22. So literally it takes, 17 years, probably longer for some other people. But I totally get it if they're a little upset by like, oh, why didn't they do that before? Why didn't they do that before? There was another firm that was called Stockpile, and I'm not with them any longer. But what they had did towards the end, they had traded. They said we're gonna trade 99 cents a share, and I was like, 99 cents a share? Where were they all these other years ago? Well, they weren't around. They weren't even around. And then Robinhood was coming out shortly after with free trading, but it was like 99 cents for a partial share. You could trade a partial share. That was also one of the first places available for partial shares, and you could trade 99 cents. They didn't have every single stock that you could buy, so I didn't like that, but you could trade with 99 cents. And so I think for me, that was the first time I saw a brokerage firm to do that. Literally, Stockpile changed. They were like the last, they were still charging 99 cents a trade, and almost everyone had gone free. And I was like, why are they still charging 99 cents? You know, and it's possibly because of the way that it happens for them. They like, everyone thinks that, it was possibly, Robinhood that did the free trading, or did stock trades. But who, like, I know for me, the first one was Stockpile. Stockpile now has a subscription where they're doing like $20 a month or something. I got an email from them and I was like, I haven't had money in there. Please do not charge me. Close my account if you need to. I was very upset because I could not contact them by phone. And it was just like, now I'm stressing out about, are they going to charge me $20 a month? And it was to have free subscriptions, but that's their business model. They were going to make 99 cents a trade on partial shares. So if you traded $250 a month on 99 cents, and once you put in $1,000, it was $395, and that was really an awesome deal for, I think, a lot of people. When, I mean, Schwab was still doing it, and the only person that I saw that wasn't, of course, doing that, there was Robinhood. There was one other trading firm. I do trade there, so I'm not going to say. And I had a Roth IRA with them, so they were trading, and I was like, that's so cool. And so I had two trading firms, but neither of them did partial shares. So that's why I was stayed with Stockpile. And then, of course, I think Schwab and Fidelity worked together, or TD Ameritrade. Within minutes or one day each other, they like said, oh, we're going to offer free trades. And that was the beginning of the end, I think, for a lot of the way a lot of firms now operate. If that was their original business model, they were going to charge for trades or something. Now they're having a subscription model. And like, I think that, for instance, Acorns is very outdated. There's too many free options out there that let you do a thing for like low barrier to entry. And you don't have to pay a subscription for like $1 a month. There's like Ellevest, and you can put in a $1 a month, $5 a month, and there's not some subscription. The subscription that they'll offer is a checking account, I think, and it's optional. And then there is Betterment. Betterment is like, I think, $10 a month, but you're not paying $3 a month for saying like, oh, the privilege of investing on an app that takes up space, and we're going to require an update every 2 seconds to take up space on your phone, and you have to create space on your phone to keep us on there. That was very frustrating. So I had to close my Acorns account. I only signed up for an account bonus, and and then now I found out they keep offering me to come back. So they offered $50. I said, oh, I'd do it for $50. And then I'd close my account after, 18 months. And so I go, wait a minute. Let me check to make sure their subscription. And so I checked in there in the apps, not the App Store, the Google Play Store. And of course, it's $3 a month. So I'm like, I would have to read all the fine print to see, how long I have to keep that open for the $50 bonus. Like, it wouldn't be for, so it wouldn't even be a $50 bonus. It would be like, let's say it was 6 months. I had to keep it in there 6 months. And, 3 times 6 is 18, right? So that's now not a $50 bonus. That is a $32 bonus. And if it goes out to 12 months, it goes down to a $14 bonus. All for what? Like, it was like maybe there's more that's included in the $3 a month. But, everyone trying to get in on inflation, and even a brokerage firm like that where what you are being offered is offered elsewhere at no additional cost. Like Fidelity does that. They have a Fidelity Go account. It's a managed account. And it's $10 minimum a month. And they even have, I think, a promo going on right now where you put in $50 to the account, and whatever account you choose, there's like a checking type of banking you need account. There is a there is Roth IRA, traditional IRA, and stuff like that. So you put in $50 and you get $100. You have to put in $50 within the first 15 days, and so you can put in a Google search for Fidelity Cash Bonus to see if that's how I did it. I think the Fidelity 100, I don't have a referral code because I don't get a personal bonus, but that was really cool. Like, okay, I get $100 and I could go do anything with that. But anyway, I'm trying to think, was there anything else? I did want to report them on CFPB, but that was really cool. So I segued out of debt into the brokerage firm arena, and I hope you had a good time. And I'm sitting down today. I usually am sitting up way over there by my counter, in that background. This says behind me, like, Dream. It says Dream Big. And so I said, well, I was trying, this phone is sitting on my desk and it's not low enough, so I'm really cut off below the chin. But I hope you have a great time. And so this was a 22-minute video, and so ask questions, comment, subscribe. I still have 0 subscribers, but I got a like and it wasn't my own. So I was really excited. I was like, maybe I should like the video too. I should like the video too, right? So like the video, subscribe, Finance Nation. I don't know if I'm gonna put out another video today. Oh, that's what I wanted to say. That should have been with this video. But I don't know if I'll be able to make a whole new video about that. So we'll see if I can get some viewers. Okay. Thank you so much. Bye. All right.